Let's go to Miami, Florida. Good morning, Bob.
Good morning. I'm a proud community banker, and having this new report that came out got me to thinking about how we sourced our loans during the crisis and even before. We did 100% of our loans face-to-face with people that came to us, applied, we verified their income, we appraised the properties at arm's length. We did things right, yet 50% of our loans defaulted. And of those 50%, nearly 50%, another quarter of them, if you will, were people who basically came to the bank and said, you know, my property is not worth what it used to be or when I bought it, and so now I want you, the bank, to share in the loss. And we were finding out that this was something that was being promoted by attorneys and by these mortgage clinics to go to a bank and tell them, you take the loss because I'm uncomfortable with the value of my home. They still had the ability to pay. And as we saw this happening, I saw a mutation in how people view credit and how they react to credit. I don't think my grandfather would have done that. My father certainly wouldn't have done that. But I had so many instances of that, that while, yes, the bigger problem were the loans that were securitized and were put into the marketplace, the grassroots lending was not over-enthusiastic, was not Pollyanna-like. We were doing things right.
And Bob, I would certainly agree with you that there were a good many community bankers like yourself who did things right. I think that's why this financial report spread the blame.
And, you know, Diane, I think Bob makes a really good and important point, which is I think it is human nature to look at something that, like what happened with the loan crisis, and say, this one thing was the problem, we screwed it up, and next time we won't do it, we won't ever have that problem again. As he points out, sometimes you can do everything right and things still go bad. That's the more troubling and anxiety-provoking thing, I think, for your average person, which is sometimes you do it right and it still goes wrong.
And here's an email with another point of view from Bob in Rochester, who says, isn't the split on the conclusions of the study of the economic crisis totally expected? If Republicans agreed that the crisis was preventable, then more regulation would make sense. Regulation is not something Republicans want to embrace.
Bob is right. Bob is right. We do need more regulation. When you've got so many unsecuritized loans that were going out over the phone, there were some horror stories of people getting loans based on their unemployment checks. I mean, that's just how irrational the exuberance got, Diane, and we all know it. This is not news. The earlier caller was right that the whole concept of borrowing, our own mental picture, broke down amidst what was called moral hazard. The moral hazard argument was what spawned the Tea Party movement. A bit late, but that is what happens, though, when you tell people, well, look, you really don't have to pay off your mortgage because if the chips are down, you can go to the bank and cut a deal. That is, unfortunately, an idea that's gotten out there. It's not accurate, but then people get mad if the bank won't make a deal. You know, so everything's turned topsy-turvy.